Guys and girls, welcome back to another Beaumont Outlook fundamental educational video, and today we're going over the economic cycle. Now, what exactly is the economic cycle? The economic cycle, also known as the business cycle, refers to the natural fluctuations of the economy between periods of expansion and contraction. These cycles are inherent to market economies and are characterized by changes in GDP. Now, for those of you that don't know what GDP is, it's gross domestic product, and it basically reflects the health of an economy. What we're trying to decipher here is the GDP expanding? Is the economy growing? Or is the GDP contracting and is the economy shrinking? Now, many factors play into this, such as employment, interest rates, and inflation. And the cycle encompasses various phases, including recoveries, expansions, peaks, contractions, and troughs, each with distinct economic indicators and conditions. Now, the first phase, which is a recovery. Now, for those of you that are new to markets, the best way to think of a recovery is when we all opened up after COVID. When economies opened back up, eat out to help out, there was discounts everywhere, you were sat with mates once again, and everybody was spending, and prices start to go up because businesses were making more. All of a sudden, we can see the economy is recovering. But let's look at the environment, what GDP looks like, so on and so forth in this recovery phase. So the environment is early signs of economic improvement after a downturn, increased industrial production, consumer spending, and employment. GDP begins to rise from a very low point that it's been at. Inflation remains low as demand starts to pick up, yet prices haven't caught up. And interest rates are typically low, as central banks aim to stimulate growth and allow for spending to reoccur. Now, at this point, the currency valuation may begin to strengthen as investors gain confidence, as, of course, we see spending occurring, we see economic indicators improve, and low interest rates may still limit the inflow of foreign investment, keeping the currency appreciation moderate but still present. Now, phase two, which is the expansion phase. The environment here looks like the economy is growing at a healthy rate, confidence is increasing, higher spending, higher investment, higher employment, and as you can see, the GDP grows steadily. Inflation starts to increase as demand pressures build, because, of course, spending starts to outweigh supply and prices rise with it. Interest rates may begin to rise here as the central banks aims to prevent overheating of pricing. At this point in time, the currency valuation is likely to strengthen as rising GDP and improving economic conditions attract foreign investment. Central banks may start to raise interest rates to prevent overheating, marking the currency more attractive for foreign investors who are getting good yield on their currency. Phase three, growth. In this environment, economies are growing at a healthy rate. Confidence is increasing once again, higher spending once again, investment is there, and the economy is growing. GDP once again is growing steadily, and of course, inflation now really truly starts to rise. Of course, central bank are beginning to rise interest rates even more to prevent further overheating, and this could be, of course, at its strongest, reflecting high economic confidence. Now, looking at the currency valuation, this could arguably be nearing its strongest, reflecting high economic activity, robust growth, and potentially higher interest rates coming its way. However, concerns about the overvaluation and impending policy tightening to combat inflation may start to emerge, which leads to recessionary talks, which we'll get onto. Now, the environment is the economy is nearing its highest point of economic activity, and that's the important bit, nearing but not at its highest point. Now, unemployment rates are rock bottom, or you could look at it as high employment rates. Consumers are absolutely confident. Businesses are profiteering left, right, and center like they've never done in a fair bit. And the economy is expanding at a very aggressive rate. Now, GDP looks like quarter-over-quarter prints are expanding and growth seems never ending. Now, on the inflation front, this is often very high as demand is completely exceeding and outstripping supply. As a byproduct of this, interest rates are rising, high and climbing to curb the inflation and control the speculative borrowing. Now, from a valuation point of view, this could essentially lead the currency to be at its strongest or nearing its strongest, reflecting high economic confidence, robust growth, and potentially higher interest rates. However, concerns about overvaluation still are lingering. Now, similar to a boom, let's talk about when the economy is at its peak. The economy in this phase is indefinitely at its highest point of economic activity, whereas when you're booming, and we have a boom, it's questionable as to how much more we can, boom. But when we're peaking, we're seeing that GDP is no longer expanding. It's hit a ceiling. We still have high employment, we still have consumer confidence, businesses are still making money, but GDP is no longer expanding. In fact, it's peaked. it's no longer growing. So from here, you see that inflation still remains high, demand is still outstripping supply, and interest rates are high because they need to curb this inflation, control the growth, and control the speculative borrowing. Now, from a valuation point of view, similar to the boom, we could see the currency is at its strongest, reflecting high economic confidence, robust growth, but potentially higher rates are now causing concerns about overvaluation, concerns about policy over-tightening, leading to the next phase, which is contraction. When you look at a contraction, why does it occur? Well, before we get into phase 6, let me just discuss something with you guys and girls. Throughout the phases of recovery, expansion, growth, booms, as interest rates have gone higher and higher and higher and higher, it's now costing a lot of people to hold debt. The interest rate is increasing on their mortgage, on their car loan. They are getting good money in the banks. They don't want to really spend their money. Inflation's risen so much due to growth rising so high and demand exceeding supply. Prices are so high, and prices can only climb to a certain level before consumers can no longer keep up with it. Well, what happens is when GDP increases aggressively and peaks, prices also peak with it. Well, why? Because borrowing costs are so high, interest rates are very high, and people can no longer afford anything. Now, in this environment, let's go back to the PowerPoint here. You see that growth starts to slow down. Economic indicators start to decline. Businesses reduce production. Consumers are spending less, and GDP begins to fall. Inflation may start to decrease due to people are buying less demand, less supply of money entering the market. And as a byproduct, businesses have to react. They have less people spending money with them now, so they have to lower their prices and thus lowering inflation. Interest rates might still be high initially, but are likely to be reduced as central banks try to stimulate the economy and avoid over-tightening. And of course, the next phase we'll get into now, which is a recession. Now, in this phase, contraction, the currency valuation may start to weaken as economic indicators are declining, growth is slowing, and investors' confidence with lower interest rates starts to dwindle. Central banks attempt to stimulate the economy, and it can lead to capital outflows, a recession. Now, of course, if interest rates have been aggressively risen over, could be 6, 12, 18 months, people are borrowing less, people are spending less, GDP is slowing, the economy is contracting, prices are easing, and if GDP contracts by 2 quarterly prints, so 2 quarter-over-quarter prints, leads us to a technical recession, well, what does that environment look like? Well, it's marked by a significant decline in economic activity across the economy, lasting more than a few months. To be, like I said, to be precise, is 2 negative quarter-over-quarter prints. High unemployment, decreased consumer spending, and low industrial production. And of course, the GDP is declining. At this phase, inflation is low due to the decrease in demand. And of course, interest rates are being reduced significantly as a measure to encourage borrowing and investing from consumers and businesses in the economy. Now, the currency valuation is likely to weaken further here as economic activity diminishes, unemployment rises, and consumer spending falls. Central banks may cut interest rates to historic lows, reducing the currency's attractiveness to foreign investors, as this confirms to investors that economy is struggling. Now, we can see recessions lead into depressions. Historically, we all know about the US depression phases of economic activity. If you don't know that, go and research it. But if a recession gets really bad, it can lead to a depression phase in the economy. Now, this is where a severe and prolonged downturn in economic activity occurs, much longer and deeper than a recession, and it is extremely high unemployment, low consumer confidence, and significant drop in spending and investment. GDP will be at record lows. Inflation can be very low as businesses have to really drop prices to attract spending, and interest rates can be very low, but monetary policy may become ineffective. In other words, it's irrelevant what rates are doing because the economy is in such a spiral and negative output. Now, in this phase, the currency valuation could be significantly weakened due to prolonged economic downturn, extremely low confidence, and minimal interest rates. The effectiveness of monetary policy in such a phase might be limited, further challenging the currency's strength. Now, once the worst is behind us, we hit a trough. We start to level out. The worst is gone, and the environment of a trough seems to be at the bottom of the economic cycle, where activity is at its lowest, but it's not getting any lower. The turning point is here. Things are starting to stabilize. As you can see, GDP stabilizes at a low level, and inflation is very low or even negative at this stage. But interest rates are at or near their lowest as central banks attempt to restart economic growth. Now, at this phase, the currency valuation might start to stabilize or even recover slightly if measures are taken by the central bank and the government, of course, to begin to take effect, signaling the end of the downturn. This could be a central bank raising interest rates slightly. It could be a central bank stopping stimulus and stop stimulating the market. Something that tells us, okay, there's a gained confidence in this market. However, the currency is still likely to be weak compared to other economies who are, of course, expanding, growing, or even at their peak. Then that brings us back onto phase one. After we trough, we then go back into recovery, growth, expansion, booms, peaks, and then we're in an economic cycle. Now let's talk about the transition from phase to phase. Now, from a trough to a recovery, usually signs of economic stability is occurring. The currency might gradually strengthen again due to improving investor sentiment and the anticipation of economic growth. In other words, investors say, do you know what? The worst is behind that economy. They're starting to show signs of recovery. Let's get in early before the expansion occurs and before they potentially boom in the next 8, 12, 16 months. But from peak to contraction, the currency might actually begin to weaken a lot as investors anticipate central bank actions to cool the economy, such as raising rates, could slow down growth and reduce investment attractiveness. In theory, a currency's valuation reflects the economic health and prospects of its country, influenced by the phase of the economic cycle. However, it's important to note that a currency's valuation is also affected by global economic conditions, geopolitical events, and market sentiment, which can sometimes overshadow, of course, the economic cycle. Remember, risk sentiment always triumphs fundamental valuations, but if you do not know where your economies are in their economic cycle, of course, you're a step behind the market. What we have here is a great lesson for you guys and girls. Remember, it's all about understanding where the economy is in its economic cycle, where they are in their next phase. Are they going to grow next? Are they going to contract next? Are they going to hit a recession next? And pinning the strong versus weak. We are always looking to buy economies that are growing, in other words, recovering, expanding, growing, booming, peaking, versus economies that are contracting, receding. Why? You have an economy that's growing and an economy that's shrinking, strong versus weak, right? You want to buy strong versus weak. Or, being more realistic, you may get phases where some economies, or globally, we're going to get phases where all economies are struggling and weak, like the 08-09 crash, but some economies will be weaker than others. You know, some economies will be absolutely melting, some economies will be melting, but not as much. So the phrase I want you to think about when summarizing the economic cycle is always try and pick the dog with the least fleas, buy it against the dog with the most fleas. So that is us on the economic cycle, guys and girls. Thank you for tuning in.